The Fed at a crossroads. PM Modi's Big Bang GST reforms and Netflix continues to win. This is Vinay Uttam, your resident stock doctor in a brand new avatar as I finally got my specs back. And welcome to a brand new episode of the Stock Doctor podcast. We are on episode 138. First of all, to my Indian listeners, hope you had lovely Independence Day celebrations. Hope you enjoyed it with your family and friends. And I hope that, I hope you had a good extended weekend. More on Independence Day. I'm sure you've heard the news, some big bang reforms happening. More on that later. But let's kick things off by just talking about the US markets, which had yet another positive week. As elevated expectations for rate cuts from the Fed, as well as increasing odds for a Russia-Ukraine deal, offered enough fuel offered enough to fuel investors' optimism. Once the dust had settled, all three indices ended in the green, with Dow adding 1.7%. By the way, the Dow Jones is the last index to actually, that had to hit the all-time high, and it finally did. S&P 500 and NASDAQ already did it, and Dow last week at some point did hit the intraday high, hit the all-time high intraday, although it pulled back later. But there you go. Dow joins S&P 500 and NASDAQ to hit all-time highs this year. So Dow added 1.7% for the week. S&P 500 climbed 0.9% for the week, and the tech-heavy NASDAQ inched a little bit higher by 0.8%. Remember, last week, tech-heavy NASDAQ, the NASDAQ had a lovely, fantastic week, nearly 3-4% jump. So 0.8% a week is still a massive win as far as I'm concerned. So let me welcome you to the first segment, Doctor's Weekly Snapshot. We've got a lot to talk about the US markets. And let me start things off by saying that if you are a Federal Reserve official, I'm not sure whether any Federal officials listen to the show, but if you do, fantastic, good for me, good, thank you for listening. But if you are a Fed Reserve official, or let me put it this way, if you want to put yourself in the shoes of Fed officials, then all I got to say is you would have had a very, very confusing week. And that is because the week started off with some key inflation data, which showed that inflation was starting to be, stabilized again. There was a couple of months where it went up and up, people were not sure, but it had started to be stable again. Which when you combine with a weakening labor market, makes it very crystal clear to you that the rate cuts are the answer for September. Interest rate cuts are the answer, the way to go in your next meeting in September. But then you had another inflation metric. So one metric suggested inflation was steady, and then you had another inflation metric which actually said prices remain elevated, and also gave a warning that companies are certainly feeling the tariff pain and are more likely to pass the costs on to the consumers. So, it's not happening right now, but the other inflation metric, which I will talk about in a little bit more in detail, did send out a warning that companies might be in a position, might be left with no choice rather than to pass the cost to the consumer. So overall, a very confusing trend indeed. So you have one metric that said inflation is steady. You have another that said, hang on a minute, prices are still rising. We have a problem. And it could very well be that the companies are now suffering, and the suffering might end once they pass the cost on to the consumer. So very, very confusing trend indeed. Now, before I explain the trend, before I explain to you why last week must have left the Fed in a very confusing state, let me first talk about the specifics. Let's start with the first inflation metric that we received, the July CPI data, right? So U.S. consumer prices increased 2.7% year over year in July, matching the same rate as of June. So 2 months back. So essentially, and actually came in below economics expectations of a 2.8% rise. So instead of rising, inflation is finally stabilizing, which is perfectly good news. Core inflation, however, which when you exclude food and energy prices that tend to be volatile, when you exclude that, you get the core inflation. Core inflation rose 3.1% over the past year, marginally above the forecasted 3% increase. So again, yeah, okay, that's not necessarily good, but when you look at the overall metric, inflation does remain steady. Now, shelter, which is housing or rent, energy and groceries, all key consumer expenses either fell or stabilized in July. Yet another good news, yet another signal that inflation seems to be holding steady rather than, off to the races because of President Trump's tariffs. So Shelter, energy, groceries, all either fell or stabilized in July, helping restrain the overall inflation figure. So if I were to give you this data, I'm only giving you the CPI data, right? If you pretend yourself as a Fed official, I'm giving you the CPI data. When you combine it with the weakening labor market that I talked about in the previous episode, then you would absolutely put your money on a September rate cut without doubt, right? Because you have inflation that is steady, but you have a weakening labor market. So the focus is on the weakening labor market. How do I strengthen it? So clearly the goal would be, let's do a rate cut in September. Sure. You ask me that same question, I would do the same thing. Here's where the picture gets a little confusing though. On Wednesday, we got the July PPI data, which is the producer price index data, that actually showed US wholesale prices jumping 0.9% month over month. 0.9% month over month might look very silly to you, but it was the sharpest increase since March 2022. So in 3 years, we've never had an increase as sharp as this. So US wholesale price jumping 0.9%, both goods and services. So it's not just goods or services, both goods and services rose notably. Wholesale goods price were 0.7% up, whereas services prices climbed 1.1% over June. So month over month, 1.1% for services, 0.7% for wholesale good. When you combine it, put it all together, PPI, the producer price index, the wholesale prices rose 0.9%, sharpest increase in 3 years. Rising wholesale inflation is seen by economists as fresh evidence that tariffs are finally showing up in the higher prices throughout the supply chain. It also gives an indication on why we haven't seen a surge in CPI because of President Trump's tariff policies. It could be because businesses have largely absorbed the tariff pain, absorbed the tariff costs, and that is what you're seeing in the PPI data. The problem, though, is that businesses may now start to pass the price hikes to customers. Some businesses have already indicated this, like some Walmart, for now have said we're not going to do it, but we cannot rule out a future where we will pass on the higher prices to consumers. Once that happens, the CPI will definitely head upwards as well. So, and also, what is making the rate cut picture confusing is that the PPI, the PPI data, the producer price index data, feeds into the broader personal consumption expenditures PCE price index, the inflation gauge most closely watched by the Federal Reserve and one that the Fed uses to make decisions on interest rates. So when you combine the producer price index and the recent CPI data, economists are now projecting July's core PCE inflation, which is expected to be released at the end of next month, at the end of the month, to edge up 2.9% year over year, which if becomes a reality, would not only be higher than the June's figure, but it would also imply that inflation is moving further away from the Fed's desired 2% target. So this is the problem. So CPI data for now remains steady, but given the fact that businesses are largely absorbing the costs, as reflected in the producer price index, it's not a very big surprise that CPI is holding steady because prices have not been passed to consumers. Now, would it happen? Some businesses have already indicated that they will do so. So when you combine all of this, it's looking a very, very confusing picture. I did tell you, if you're a Fed official, I don't know. I wouldn't know what to do. I mean, for me personally, I think the Fed should do a rate cut again. I'll give you a little bit more detail on that. But don't get me wrong, it's a very confusing picture altogether. So as investors, we have a lot of thinking to do. The question that we need to ask ourselves is, would the Fed take the view that overall inflation remains steady and given the weakening labor market, pull the trigger on a rate cut? Or would it factor that given the rising wholesale prices, it would mean that businesses would eventually pass the costs on to consumers, which would feed the CPI inflation dragon again. And as a result, it is better to adopt a wait and watch approach in September. For now, and these things can dramatically change, investors seem to be backing a rate cut in September. And that is why you saw, despite the PPI, there was some pullback when the PPI data got released, but overall stocks ended the week in positive. So they are backing a rate cut in September. And as of Monday evening, at the time when I was doing the script for the show, according to the CME Group's FedWatch tool, traders have penciled in an 83.1% probability of a 25 basis point rate cut in September. And when one looks at the remaining meetings, so they have September, October, and December. When one factors in October and December meetings as well, then traders are expecting up to 3 rate cuts. In fact, Goldman Sachs economists have actually projected 3 rate cuts for the year. I mean, my opinion, this might be a bit of a stretch. I don't think the Fed, in my opinion, needs to do a rate cut every meeting from now until the end of the year. Given that inflation, although remaining steady, is yet to reach anywhere near the Fed's 2% target. Having said that, never ever forget that it's a twin mandate. It's not just the inflation, but you've got to also focus on the labor market as well. And don't forget that the labor market isn't the same as it was. So leaving it too late before cutting rates will certainly be an issue, be a problem, not just for the markets, but for the US economy, in my opinion. Now, the good news is that investors won't have to wait for too long to get a glimpse into how the Fed is thinking. The famous or infamous, however you want to see it, Jackson Hole Summit is taking place this week, which brings together some of the world's most well-known central bankers, economists, and financial experts. I call it infamous because this is where, back in 2022, Fed Chair Jerome Powell gave his what I call 8 minutes of pain speech that led to a colossal sell-off in the markets as the Fed accelerated its rate hiking cycle. I mean, this show has been going on for, it will turn 4 years old next month. So clearly 2022, I have covered the Jackson Hole, 8 minutes of pain speech. So you got to go back all the way back to 2022 to really know, more about it. Or you could look at other financial media outlets, of course. But all I'm telling you is, I call it infamous. I call the Jackson Hole Summit infamous because of this. It was 8 minutes of pain. Didn't take any questions from reporters. Came in, opened the thing, gave his 8-minute speech, walked off like a badass. Unfortunately, for the markets, that badass walk led to a colossal sell-off, and the Fed accelerated its rate hiking cycle. The question now today is whether pain or relief would be the theme of Chair Powell's speech this year. I'm currently leaning towards relief, as I do anticipate Fed Chair Jerome Powell to hint at a possible rate cut in September. Keep in mind that the Fed still has the August inflation and the employment data to consider before making a decision in September. The way things are trending, I'm leaning towards 2 rate cuts by the end of the year, one in September, one possibly in December, because I think the October would be the wait and watch approach. But then again, I'm no Fed official, so I can only make calculated guesswork as an investor and make my investment decisions accordingly. So the best I can give you with respect to all of this is to basically ask you to tune in this Friday for the all-important Jackson Hole meeting, where Fed Chair Jerome Powell will be delivering his speech. The official theme for this year's Jackson Hole Summit might be labor markets and transition, demographics, productivity, and macroeconomic policy. But as investors, we always know that the theme of Jackson Hole Summit, at least in the last 3 years, has been pain or relief. On that note, let's head to India now. In our next segment, the doctor goes home. And like I said, first of all, hope all my Indian listeners had a lovely extended weekend back courtesy of Independence Day. And who knew that a holiday, when markets are not trading, business is shut, everything's happening, would be the one day that would actually bring the biggest market moving news, one that has the potential to be a game changer for the Indian economy when it comes to long-term growth. I am, of course, talking about the blockbuster announcement made by Prime Minister Narendra Modi during his Independence Day speech, a 103-minute Independence Day speech, when he announced plans to reform India's goods and services tax GST system. The overhaul is the most extensive since 2017 and aims to simplify the goods and services tax regime. Daily essentials and electronics are expected to become cheaper as a result. The primary change expected is a reduction in GST rates by Diwali. Happy Diwali indeed. Already Diwali has indeed come early for both investors and for the Indian consumer, specifically aimed at lowering the prices of everyday items, signaling a significant overhaul of the 8-year-old indirect tax regime that has faced challenges like litigations and tax evasion. Let me first take you through the specifics, like I always do when it comes to such big bang reforms, before going into detail as to what it might mean for what it means for the Indian economy and for investors like you and I who do invest in the Indian markets. Now, according to the Big Bang GST 2.0 reforms, the Finance Ministry proposes moving from the current 4 GST tax slabs, 5%, 12%, 18%, 28%, to 2 main slabs, standard and merit. Essentially, 4 would cut into 2, 5 and 18. So they're going to get rid of 12 and 28, only 5 and 18 would remain. In other words, the GST structure is set to move from multiple slabs to two principal rates, 5 and 18, with a higher 40% for luxury and sin goods. Nearly all items currently at the 12% GST may move to 5%, and this goes to show why it's such a big bang reform. And 90% of the goods in the 28% GST slab today may shift to the 18%. It's a blockbuster deal, right? 28 to 18 is no small number. Similarly, 12 to 5 is no small drop. It's a colossal drop. And if everyday items go from 12 to 5, that's consumption bonanza for the Indian markets, for the Indian economy. Now, the proposed reforms are expected to unleash consumption, and they come at a time when consumption has actually been struggling, especially in urban areas. Lower GST rates should increase domestic consumption, helping offset the external economic shocks and fueling demand, particularly among the MSMEs. Brokerages anticipate a massive 2.4 trillion rupee demand boost, which is expected to add 50 to 70 basis points, that's 0.5 to 0.7%, to addition to India's GDP growth on an annualized basis. Lowering GST rates will especially help low-income households as indirect taxes are regressive. This is anticipated to reduce consumer prices, and obviously that would mean increased discretionary spending. For investors, it's all about which sectors are expected to benefit the most. And if you look at yesterday and today, if you look at yesterday's and today's market action, you would definitely know which sectors I'm talking about. If you haven't, let me tell you, majority of the biggest beneficiaries, autos for sure, especially two-wheelers, small cars, hybrids. No wonder that Maruti Suzuki hit a 52-week high yesterday, and I think it's even trending as things, last time I checked, it's hitting a new high today as well. Consumer durables, cement, consumer staples, hotel, retail, logistics, quick commerce, EMS, and select food companies all are expected to benefit from this big bang GST 2.0. It was no surprise then that yesterday the biggest gainers were auto stocks, with Maruti Suzuki and Mahindra hitting new 52-week highs. They are hitting new 52-week highs today as well as I'm recording this. Fabulous day if you're a auto investor like me, right? Biggest investment. If you invested in two-wheelers as well, like TVS Motor, Hero MotoCorp, you would have had a fantastic day yesterday. Based on initial analysis, the blockbuster reforms could also reduce inflation by 40 to 60 basis points at 0.4 to 0.6% as GST rates decline. Of course, not everything is hunky-dory. We have to take the other side as well, which is that lower taxes would imply revenue losses for the government, which is currently projected at 0.4% of the GDP annually. However, analysts do suggest that higher GDP growth and improved tax collections, direct and indirect, should help offset these losses. Government officials noted that they have options to offset these losses, but they haven't given any specific details. To me, really doesn't matter as we are still in the early days, and I do believe that the higher GDP growth should offset the offset the revenue loss in the long term. Yes, of course, there will be some short-term hit, but I don't see this as a long-term problem. Bottom line, at a time when the Indian economy is facing a bit of a tricky situation, thanks to President Trump, remember 50% tariff. If you don't, all you got to do is watch episode 137, which is last week's episode where I talk about it. GST 2.0 is exactly what the doctor ordered. You had a blockbuster budget 2025, which gave Indian consumers tax cuts. And now, 6 months later, you have GST 2.0. Add to this the interest rate cuts by the RBI, with more to come from the central bank as inflation stabilizes, and everything is coming together for the India growth story to fire on all cylinders. Well, there could be a short-term hit to consumption as consumers wait until Diwali to get more clarity on the reforms. In the long term, to quote one of the Economic Times articles that I read yesterday as part of the preparation for this show, buckle up for a consumption cycle that could redefine India's growth trajectory. On that note, we're heading to the final segment, Dr. Dissects, where one of my favorite stocks and my favorite streaming platform goes under the microscope this week. I'm obviously talking about streaming giant Netflix, ticker symbol NFLX. Netflix reported its Q2 numbers last month, and it was a strong one. It beat on both the top and bottom lines once again. Q2 revenues of $11.1 billion were up 15.9% year over year, and they beat analyst estimates by $22.8 million. Diluted EPS came in at about $7.19, and which was up 47.3% year over year, and it beat analyst estimates by 10 cents. Operating margin strong once again, expanding by 6.9% to 690 basis points, however you want to see it, coming in at 34.1%. The company also generated free cash flows of $2.27 billion, significantly higher than the 1.2 billion it generated in the same period last year, but it was lower compared to the previous quarter. Now, the company raised the full year guidance after reaffirming its guidance in the previous quarter. So Q1 saw reaffirmation, Q2 saw raising the guidance. More specifically, full year revenues are now expected to be in the range between $44.8 and $45.2 billion. Previous guidance was 43.5 and 44.5 billion. Operating margins are now expected to come in at 29.5%, marginal increase compared to the previous guidance of 29%. It was once again a brilliant quarter for Netflix, in my opinion, and the company's ability to continue to deliver strong, diversified content enabled the company to post not only strong numbers in Q2, but also allowed the company to raise its guidance. When one looks at the content slate, both current and expected, then investors would realize the company is placing a greater emphasis on ensuring that there is a fine balance between the English content and content from across the world. This diversified content slate is certainly paying off, as evidenced by the strong revenue and EPS growth that the company managed to deliver. Q2 was no different. For instance, Q2 saw series such as Secrets We Keep, which is Danish, Asterix and Obelix, The Big Fight, Asterix and Obelix lovers, you would enjoy this, French, The Eternaut, which is Argentinian, all generating views in excess of 15 million. Furthermore, Extraterritorial, a German movie, became the fourth most popular non-English language film ever, generating 89 million views. If you guys have seen any of this, please drop in the comment section once the episode gets published. Would love to hear your views. And if you really like, if you're recommending it, I'll take a look. I haven't seen any of them, but I would love to take it. If you guys have watched it, do let me know. And happy to take your view recommendations into and add it to my watch list. In addition to all of these, the company also saw its new animation film, K-pop Demon Hunters, become one of the biggest company's biggest animated film ever. I mean, you can't go anywhere without hearing the word K-pop Demon Hunters. I'm with my friends, with in my at the university, whenever I do visit it, it's all everyone's talking about is K-pop Demon Hunters. So, I mean, no wonder then that it became one of company's biggest animated films ever. With the songs from the movie setting, even songs from the movies were setting records. This is a movie, it's a fictional song. It's a song from the movie, and apparently that set records. And investors shouldn't forget that Q2 was indeed the Squid Game quarter, with the final season hitting 122 million views and becoming this, I was one of them, and becoming the sixth biggest season of any series in the company's history. Now, this strategy of offering a diversified content slate is expected to continue in the coming quarters as well, with series such as Season 3 of Alice in Borderland, which is Japanese, Troll 2, Norwegian, set to join the likes of Season 2 of Wednesday. Apparently, Wednesday Season 2 finale is coming in September 3rd. I haven't watched it yet. Do let me know in your comments, should I watch it or not? And the final season of Stranger Things in the second half of the year. Now, that I'm definitely excited. November 26th, volumes, first few episodes, then you have Christmas Day, and then New Year's Eve. Fabulous. I'm all excited, gunned up, geared up, wherever I am in 3.5 months, definitely ready, all geared up to watch. I'm sure most of you are as well. Furthermore, the company Netflix also announced its partnership with French broadcaster TF1, which would result in TF1's content being really offered on Netflix. Now, it is very clear then that a diversified content slate combined with its selective live programming is paying off and will continue to pay off. However, when one looks at the company's guidance increase, then investors would notice that the raised guidance is predominantly due to the tailwinds from the weakening of the US dollar. This catalyst is not something the company can rely on forever, and for a company that has been a growth machine, attributing increasing guidance to FX tailwinds is slightly disappointing for me, at least to me as an investor. This probably explains why the stock actually dipped after its earnings release, and its short-term momentum has actually weakened significantly since then. The question then becomes, how does Netflix take its game to the next level? The answer lies, in my opinion, in the company's ads business, which has become more vital than ever now for the company. The company has set a target to roughly double ads revenues in 2025, To achieve this target, the company is making some major moves. For instance, the company announced that it has rolled out the Netflix Ads Suite, the company's in-house first-party technology platform to all its ad markets. It also announced the Yahoo DSP will be integrated into the company's programmatic offering. And finally, the company also mentioned in the US that its US upfront is nearly complete. The majority of the deals with the major agencies are now locked in. The moves that the company has made are certainly significant, in my opinion, but question marks still remain. As an investor, I obviously got to scrutinize, right? Love the company, but I can't fall in love with the stock. So, emotionally. So, got to scrutinize, got to look at the criticism. So, question marks still remain, given that the ads business is still in its early inning. The moves certainly offer hope that the company will achieve its target to double ad revenue by 2025, which would then become the foundation from which the ads business can become the company's next growth catalyst. While hope doesn't guarantee anything, the way that the company has gone about building its ads business and the strategy to keep the ad tech platform in-house certainly shows that the company is indeed on the right track. Having said that, it's vital more than ever that the company scales up the business without any delays. Content itself cannot fuel the growth machine called Netflix. And with that, I've got a pen in my notebook. Oops, pen falls. Pen notebook ready, which can only mean one thing: we're going to value Netflix. Okay. As I mentioned earlier, the company raised its FY25 guidance. Revenue is now expected to come between 44.8 and 45.2 billion. Company has already beaten its own revenue estimates in the first half of the year. As such, I'm assuming the company would, at the very least, hit the high end of its range, projecting FY25 revenues to be 45.2 billion. Projected FY25 revenues 45.2 billion. Based on management guidance, operating margins for FY25 are expected to come in at 29.5%. I have assumed this figure for my calculations, even though operating margins in the first half of the year were significantly higher. And this is because management reiterated during their earnings call that the content spend is expected to be much higher in the second half of the year. Obviously, stranger things coming in, you've got marketing expenses and so on going up. Operating margins of 29.5 would imply FY25 operating income to be 13.33 billion. 13.33 billion is the FY25 operating income. My other projections remain the same since the last time I talked to you about the company. Non-operating expenses, I expect them to come at 662 million. Tax rate should be 12.6%. When you take all this together, it would result in an FY25 net income of $11.07 billion. According to the company's latest income statement, on account of repurchases, the weighted average shares of common stock used to calculate the diluted EPS have come down to 434.9 million from 436 million. When you do that, when you combine that, when you take the figure of 434.9, FY25 diluted EPS would come in at $25.45, which would imply a year-over-year EPS growth of 28.3%. According to Seeking Alpha, Netflix currently trades at a forward PE of 47.1, significantly higher than its 5-year average of 41.8. However, Netflix has seen its EPS growth jump significantly in recent times. My projections put the EPS growth well above its long-term average growth of 21.4. I'm projecting EPS at 28. Long-term average is 21. So as such, I've assumed a forward price to earnings of 47.1x. You make that. It's not 471, it's 47.1x. Now, according to Alpha Spread, according to Seeking Alpha, the company currently trades at a forward PEG ratio of 2.01, significantly higher than the sector median of 1.5. If you put a forward PEG ratio of 2.01 and a forward price to earnings of 47.1, then EPS growth would be about 23.4%. At a forward PEG ratio of 1.5, however, EPS growth would be 31%, more reasonable estimate, in my opinion, given the catalyst the company has, for its growth. As such, I've assumed an EPS growth of 31% for FY36, and this would mean FY26 EPS would come in at 33.34. So I've assumed an EPS growth of 31%. FY26 EPS would come in at 33.34. According to Alpha Spread, Netflix has a cost of equity of 7.86%. So when you discount it back to today, the present value of FY26 EPS would become 30.91. And then what you do is you take 47.1, multiply that by 30.91, and you get a price target of $1,456, significantly higher than my price target of $1,095. So this is my price target. And this would mean representing an 18% upside from current levels. So $1,456 is my current price target, updated price target, 18% upside from current levels. However, the problem is Netflix's short-term momentum, as I mentioned before, is weak. It has a C+ grade on the Seeking Alpha's momentum scale. As such, I'm only maintaining my buy rating on the stock. I'm only maintaining buy rating on the stock rather than upgrading the stock to a strong buy despite significant upside. So buy rating with a price target, 1,456. And a bull case only means one thing. I have to highlight the risk factors. The primary risk factor in my bull case is whether the company's ads business can achieve the target set by the company. Simple as that. Netflix has rolled out its own ad suite across all its markets, but execution remains key. Should the company fail to meet or exceed its ads revenue target, or should there be any glitch in its ad suite, then it would be a major headwind to the stock. The other risk factor is the drop-off seen in the free cash flow on a sequential basis. While the company continues to generate strong cash flows, investors should keep an eye out for this figure. Any continued drop-off in free cash flow is definitely a cause for concern and would be another headwind to the stock price. Bottom line, Netflix had a strong quarter once again, with a beat on both the top and the bottom lines. The company strategy of offering diversified content paid off once again, and with some much anticipated content set to be launched in the second half of the year, Netflix investors can feel confident that it will be yet another blockbuster year for the streaming giant. Having said that, the decline in free cash flows and the company having to rely on FX tailwinds to raise its guidance is disappointing and does suggest that strong content on its own won't be enough going forward. This is why the success of its ads business has become more important than ever. I am certainly confident that the company would make its ads business its next growth catalyst, especially with the moves that it has made in the current quarter, as well as the degree of urgency with which it's scaling up the ads business. Company can't afford any more slip-ups though, without the growth of this ad segment, because if it does, then the overall growth story may stall. From a valuation perspective, Netflix continues to remain attractive to me. 18% upside, 1,456 price target. You all know this, but given the momentum is certainly slightly weak, I would recommend a cost averaging strategy, and that's why I'm just maintaining my buy rating rather than upgrading it to strong buy. Netflix continues to be the king of streaming, no doubts about it. However, for the king to keep his throne, content itself is not going to be enough. Over to you, advertising. That's all the time I have for you this week. If you have a specific Indian stock or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening, guys. I will see you all next week once again. Until then, stay safe and make some money.